The 6 important financial parameters. Finding a wonderful company with a great financial record can be quite a task for the uninformed. The flood of numbers in a company's annual report can tie a layman up in knots. The simplest way to cut through the confusion would be to focus on only 6 crucial parameters. Taken together, these 6 parameters observed over a 10-year period will help to gauge the financial strength of a company. What is the first thing that you will look for a company before investing in it? You will check whether it has been making profits consistently. Since we will be shareholders, we need to look at the profit it earns per share. Hence, the first parameter to look for is EPS, earnings per share. EPS is arrived at by dividing the net profit by the number of shares. However, it is said cash is king. Hence, to verify that profits earned by the company are leading to an inflow of cash, you have to look at the second parameter, that is, operating cash flows. Net operating cash flow is the actual cash generated by a company from its business. If a company cannot generate adequate operating cash flow, it may need to rely on outside funding to meet its financial obligations and even to run the day-to-day operations. Now, how can a company churn out profits repeatedly? By selling more and more products every year. Hence, the third parameter to look for is net sales. To increase its sales in the long run, a company must keep expanding its capacity. The fourth parameter, book value per share or BVPS, tells you how much the company is investing in expanding its capacity. A company is like a machine, using money to make more money. And machines are rated by their efficiency. Companies produce profits using the capital invested, both equity and debt. Return on invested capital, or ROIC, will tell you how efficiently a company is using its capital. This is the fifth parameter. But borrowing money can sometimes lead to difficulties in repayment, which can be catastrophic. The sixth parameter, debt to net profit ratio, tells us the number of years it will take the company to repay its debt. But how can we tell if these 6 parameters are great or not? What value should these parameters have? We have found that all the best companies meet a certain standard, which we call the gold standard. A company which has grown its EPS, operating cash flow, net sales and BVPS by 12% or greater year-on-year consistently for 10 years, ROIC over 12% every year, a debt to net profit ratio of less than 3 has met this gold standard. Apart from these, you can also look at the company's past performance with regards to its profit margins, OPM and NPM, return on equity ROE, debt on equity ratio, and the working capital management. These will help you gauge whether the company's finances are being managed effectively. Now that you have found a company with a solid financial track record, you are ready to look at its competitive strengths.